It's Friday, 2nd of August, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Slightly different format this week. We've just had a grim US payrolls report. Recession talk is in the air. US stock markets are about to open and is looking like another tough day of trading. So what's really changed here? Is the US economy heading for the rocks? Are we seeing a fundamental shift in the stock market, or is this just another blip before the rally resumes? To find out, I'm joined by Group Chief Economist Neil Shearing and by Jonas Goltermann, who's our Deputy Chief Markets Economist. Hi Neil, hi Jonas.
Hi David.
Hi David.
Neil, let's start with you. It has been a packed week of releases. It's been capped by that July payrolls report. Market reaction kind of speaks for itself, doesn't it? 114,000 jobs increase versus 170,000 expected. Unemployment rate at 4.3%. I mean, put it all together, are we heading for a US recession after all?
Well, I don't think we're there quite yet. It was certainly a pretty grim report. As you say, not only was the gain in non-farm payrolls lower in July than consensus expected, and indeed we had expected, but the unemployment rate rose too. Interestingly as well, the June increase in payrolls was revised lower, and I think I'm right in saying that's the 6th out of 7 months in which the initial gain in non-farm payrolls has been revised lower subsequently. So there's a pattern emerging there that's worth keeping an eye on. But certainly a weak payrolls report, yes. And it's important, the US labour market is critically important because when we think about recession, and the whole notion of recession is not really about 2 successive quarters of falling GDP. The real recession happens when there's reflexivity through the jobs market. That is to say, in which weaker demand leads to lower rates of hiring, higher rates of firing, which itself leads to a further weakening of demand and therefore output. So there becomes this vicious cycle emerging through the labour markets. That's why we focus on the labour market in particular when we think about the risk of recession. And there's some warning signs for the Fed and for investors in this report. Now, your question was, are we in a recession? I think the answer is not yet, no. We need a bit of perspective here. It was a pretty grim employment report for July, but if you look at average weekly hours worked, that declined a bit, but not by much. So it doesn't scream recession there. And of course, it wasn't the only piece of labour market data that we have received over the past week. Earlier in the week, we got the JOLTS report on job openings and quits. Job openings edged down a bit, but not by much in June. And also, if we look at hiring, that's slowed. But if you look at firing, so the rate at which firms are laying off workers, there's not really been a pickup there yet. So, bit of perspective required. It was a pretty grim July employment report. If we get another one of those, then certainly I think we'll start to talk more about recession, but we're not quite there yet.
Right, but that 2.8% rise in GDP in the second quarter does look a lot more in the rearview mirror now than even was last week. I mean, what are the key releases that we're going to be looking at in the coming weeks to gauge how much trouble the economy's in?
Well, I think there's a couple of things we should be keeping our eye on. And in all of this, you need to keep in mind that some of this data is lagging. However, I think it falls into 2 broad camps, really. One is to do with the labour market, and one is to do with the health of the US consumer. It was the strength of the consumer that underpinned strong GDP in Q2 and has so far meant that the US has avoided recession despite the most aggressive monetary tightening cycle by the Fed in 4 decades. When we get July's retail sales, pay very close attention to what's happening there, and in particular with the control group of retail sales. And then more data from the labour market. So what's happening to job openings, what's happening to quits, what's happening to firing rates in the JOLTS report for July. And then, of course, we're going to have one more employment report for August before the Fed meets in September.
Let's talk about the Fed. They were criticised for raising rates too late as this inflation surge kicked in, including by us. Are they now running the risk of moving too slowly in easing policy?
I think there's a real risk of that, yes. I mean, we've spoken before, haven't we, on this podcast about how if policymakers wait until core inflation is back at or below its target, then they've probably left things too late because inflation, as I was saying earlier, there are lagging indicators and inflation is one of them. So there's been a risk all the way through the cycle that they leave things too late. And of course, we were arguing earlier this year that the Fed should be cutting at its May meeting. Now, the economy, to be fair, fared better in Q1 than we were anticipating. But I still think that a May cut wouldn't have necessarily been a disaster. So I think there's a real risk that they've left things a bit late. I guess the rejoinder to that is that if they have, then they could always move by 50 basis points in September if August employment report is a shocker. And of course, there's always one piece of data that tends to kind of push the Fed into and other central banks into easing. It took a weak employment report in 95 to push the Fed into easing then. So yeah, it may be that this is the one, and they can still secure that soft landing that until this week at least appear to be within their grasp.
Where does this leave us? I know we've now got 3 rate cuts in our forecast through the end of this year, starting in September. There is talk in the market today about an intra-meeting cut that you just hinted at, perhaps a bigger than 25 basis point cut for their first time out. Talk about what the Fed could do from here into 2025.
Look, I don't think we're in territory of intra-meeting cuts, not least because that would run the risk of backfiring, sowing seeds of panic, and the Fed is clearly going to want to avoid that. So I don't think we're in that territory. The data are not that weak. Likewise, a 50 basis points move would require, I think, a substantially weaker employment report again in August. But I do think September cut is now nailed on. And as you say, we've got 125 basis point cut in the remaining 3 meetings this year in our forecasts. So to look at that, meaning, as you say, we've got 125 basis point cut at each meeting left this year, September, November, December. And then we've got further cuts next year, taking us down to a target range of 325 to 350. So the Fed's taking us full off the brake pretty quickly here, but I don't think the world economy is so weak, or indeed we've not seen signs of stress in financial markets that would warrant extraordinary action like 50 basis points of cuts or intra-meeting moves.
Jonas, let's turn to you. Obviously, lots of noise in the market. We're in the middle of earnings season. The election is rumbling along in the background. Now we've got this ugly employment report. Putting it all together, talk about what's driving this market.
Well, I think a lot of what we've seen this month, a lot of what we've seen in July, I should say, at least until the past couple of days, it can be explained by, simply stress positioning, getting outbound very quickly. For example, the rotation in equity markets away from the big tech names that had done so exceptionally well in the first half of the year in favor of small caps and sort of other unloved stocks. In currency markets, you've seen a surge in the yen, sharp falls in currencies like the Mexican peso as a carry trade has unwound. That sort of, turbulence or a shakeout in the markets that happens from time to time when everyone gets too far over on one side of the boat and then suddenly they have to move to the other side. But what has changed over the past couple of days, first the weak ISM print on Thursday and now this shocking payrolls report, is that you've seen more of the pattern that I would associate with a recession scare or perhaps the start of an actual recession. We'll have to wait and see on that one. But you've seen bond yields fall very, very sharp, stock prices falling at the same time, right? Usually, certainly over the past 2 or 3 years, that's not been the pattern we've seen. Typically, it's been bond yields up that has caused stocks to fall. But now, which is associated with, inflation fears driving the market. But there's been a change there. And also, we've seen the whole equity market weaken now. It's not just the big tech firms that are under fire. So it does feel like maybe a paradigm shift is taking place. Certainly, it seems that inflation is no longer the main concern. It's recession fears that are driving the market that are front and center now.
And when the Fed starts easing in September, as we're currently forecasting, do you think this move to loosen this restrictive policy is going to help shore up sentiment, maybe turn things around?
Well, I'm not so sure about that. First of all, I think the point that Neil made is a very good one. An intra-meeting cut in August, or even a 50 basis point cut in September, although that is now what the market is getting pretty close to pricing in. I wonder if that might just lead to a sense of panic and might actually make things worse. And the other point is that what we've seen now in the past few days is a pretty massive repricing of expectations for Fed policy, and market is, like I said, already discounting a good chance of a 50 basis point cut in September, more than 100 basis points cumulatively over the rest of the year, and more than 200 basis points overall going into next year. And yet the stock market is still sold off sharply. So when people talk about the Fed saving the day or this concept of the Fed put, that only works when the Fed can cut more than what is already expected. And that's a pretty tall order now. In fact, I think we can say pretty confidently that that would only happen. They would only cut more than what's in the market if the economy is clearly in a recession. And in that world, I think Fed cuts are an offset that can help cushion the blow. But I don't think, there's never been a recession where the stock market doesn't fall further as it takes place. So in a sense, investors have already at least partly exercised the Fed put, and it's not been enough to do more than maybe soften the blow for the stock market.
Until a couple of days ago, all the talk was about big tech. Their earnings have been coming out. I think the kindest thing we can say is that they've been mixed so far. But given the role that these stocks have played over the past few years in driving certainly the S&P 500 to ever new highs, where are we now in terms of big tech as a driver of the stock market? Is that theme now over, do you think?
Well, I think I'm probably it's too soon to say that. That these stocks, depending on any count, they make up a third or even more of the market. So they're always going to be a big driver one way or the other. As you say, it's been earnings season, probably hasn't gotten as much attention as maybe it normally would, what with all the news on the macro front between various central banks, and now there's this poor recent macro data. And yeah, earnings have been mixed for the market as a whole. It's been definitely mixed within the big tech segment, and that's not helped sentiment, obviously. Of course, the big one that everyone is waiting for is Nvidia, which has been, the poster child of the sort of AI bubble that we've seen over the first part of the year. And then their earnings report is still 3 weeks away. They report quite late compared to everybody else. Look, my feeling until today, at least, was that, this rotation away from big tech might have a bit further to run, but eventually the AI narrative would reassert itself, at least provided that, Nvidia delivered the goods in its earnings report. That is kind of what happened back in April. You had a bit of a correction in equities, a bit of nervousness around the AI narrative, whether, tech is already priced for perfection and can they actually deliver on all the hype. But back in May, Nvidia earnings absolutely knocked it out of the park, and tech sector rallied and pulled the rest of the equity market, or at least the overall index, higher. And I figured something similar might play out again this quarter. Now, I think you've got to be less confident in that because, we have been very optimistic about the prospects of AI and for the stock market consequently, but there is no narrative that's completely invincible. I think a bubble needs a supportive economic backdrop. Our base case for a soft landing, that's certainly a supportive soft landing and Fed cuts, moderate ones at least. That's I think is a constructive backdrop. But if we get a more serious recession scare taking hold, or if there's an actual recession later this year, then I think we could be in for a deeper setback, both for big tech and certainly for the equity market as a whole.
So $64,000 question: what we're seeing, is this just another blip, a bout of profit taking, a few fears about economic softness, or are we seeing a fundamental shift in the stock market narrative?
Well, there's this famous quote that I quite like: the stock market has predicted 9 of the last 5 recessions. I think it's from quite a long time ago, the 60s or 70s or something, but it still holds true. It certainly held true in my lifetime. I can remember 3 recessions, if you include the COVID one, and a lot more than 3 times that the stock market has sold off sharply in expectation of a recession. Just think back to March 2023. The market convinced itself that there was going to be a banking crisis and that would cause a recession, and bond yields fell very sharply, stock market fell, but that blew over pretty quickly. So there's a good chance that this one will blow over too and the stock market rebounds. That's still the base case. But as Neil was saying, we just have to see how the data plays out over the next couple of months. How much substance is there to this fear that's out there now? Because at the end of the day, it's the data that will decide. Data is king in economics and markets.
Thanks, Jonas. Thank you, Neil. Jonas is going to be online on Wednesday with Chief Markets Economist John Higgins to talk all about what's happening in US equities. It's a drop-in. That's one of our short-form online briefings that was set up before this payrolls data, so there'll be even more to talk about. I will add a link to that event in the podcast notes for you to register and get your markets answers direct from John and from Jonas. I'll be back with Neil next week to see where we've got to, whether the dust has settled on all of this or if markets have taken another down leg and speculation about Fed easing has intensified even more. Until then, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.